Hey option traders, let's talk about a commonly used option strategy known as the calendar spread. Calendar spreads are also known as time spreads because they use the same underlying asset and strike price for each leg of the trade, but different expiration dates. This strategy can either be done with 2 puts or 2 calls. As we know, there are only 2 types of options, calls and puts, and there are only 2 things that we can do with these options. We can buy them or we can sell them. A calendar spread is a low-risk strategy that profits from the passage of time and an increase in implied volatility. It's best to find stocks that have lower implied volatility relative to the overall market at the time of initiation, and then profit off an increase in volatility. The call calendar spread strategy works by selling a call option in a near-term expiration cycle and buying a call in a longer-term expiration cycle on the same underlying stock. Both options use the same strike price. Buying the longer-term option and selling the shorter-term option increases capital efficiency, which means it doesn't require a lot of buying power. Also, more rapid time decay in the short near-term option than in the longer-term option is typically how the profit is made on this trade. Similarly, the calendar spread with put options works by selling a put option in a near-term expiration cycle and buying a put in a longer-term expiration cycle on the same underlying stock. The difference between the 2 spreads is the directional assumption. Traders typically use call options unless the trade has a bearish bias, in which case they would use puts. So let's look at an example here. Say I'm looking at XYZ stock. Implied volatility is low and I have a slightly bullish assumption. This could be a good time to put on a call calendar spread. Say the stock is trading at around $50 a share. To set up this calendar, I'm going to look at buying a call with a 55 strike that has 90 days or more to expiration, and then selling a call with a 55 strike that has less than 45 days to expiration. You pay a premium of $5 per 100 shares or $500 per option contract for the first call, and receive a premium of $3 or $300 for the second call. So this trade then costs you a net premium of $2 per share per contract, or $200 total. And $200 would also be the maximum possible loss for your calendar spread. The maximum profit occurs if the stock finishes at the strike price at expiration of your sold option. But an exact maximum profit amount and the break-even can't be calculated due to the differing expiration cycles used. However, the profit potential and break-even area can be estimated. So using the prior example, say at expiration of the short-term call option, the stock price is still below the option's strike price of 55. Then the short call will expire worthless. If the long option is worth more than $2 or $200, you'd see a profit on your overall position. That's because you paid $2 up front for the calendar spread. If the remaining long call is now worth $3 or $300, then you would have a net profit of $1 or $100. So there you have some of the basic mechanics of the calendar spread, both with calls and with puts. Please remember that if you're new to options, make sure you practice with a virtual account before risking any real money. And remember that options are complex and investors can lose 100% or more of their investment in some cases. Check out the new Options Trader app from IBD for more digestible options education and tons of great trade ideas.